Hey there, Money Moguls in Training. We are back for another episode of the Do.Different.Better Show, where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, CEO of Social Impact Now, Connective Institute, and Managing Director for the Integrated Capital Fund. Thanks for joining me today. Last week, I had the pleasure of interviewing Luana Whitmore, founder and CEO of NextFem Financial. She has created this amazing platform for those of you who weren't able to join us to help small business owners, particularly female business owners, get their finances on track. I hope you took advantage of the discount code and to take your next step in your financial journey. But today we're going to be diving deep into something that affects nearly every part of our lives, and that is our credit score. Yes, that mysterious 3-digit number that can make or break your ability to get a loan, buy a car, or even rent an apartment. If you've ever wondered how your credit score is calculated or what you can do to improve it, this episode is for you. We're about to uncover the truth behind credit scores and, most importantly, show you how to take control of your credit score. So let's start by breaking down what is a credit score and why it really matters so much. Ready? Let's go. All right, so let's begin with the basics. What is a credit score? It is the simplest, in the most simplest terms, a credit score is a numerical representation of your credit worthiness as deemed by financial institutions. That's a very important part. Think of it as your financial report card, a snapshot of how well you are managing your credit and your debt. The higher the score, the more trustworthy you appear to lenders. Okay? In the United States, credit scores typically range from 300 to 850. A score of 700 or above is generally considered good, while anything below a 600 is considered poor. Your credit score is calculated by a few companies, the most common being FICO, and you may have heard of them, and Advantage Score. Both use very similar methods to assess your financial journey, but there might be a slight variations depending on which company is calculating your credit scores. Now, you might be wondering, why should I even care about this number? Well, your credit score can impact more than just whether or not you get approved for a loan or a credit card, and it can also affect the interest rates that you're going to pay in terms of a mortgage. And remember, we've been talking about home ownership, we've been talking about leveraging and buying real estate as an investment property, but it can also impact your ability to rent an apartment, and sometimes even job prospects. It is now becoming a more and more common practice that job employers are pulling credit scores to see how are you managing your own personal life, especially in higher level positions, particularly higher management or executive level positions. But your employers are checking your scores when you're hiring, especially in those positions related to finance. Because if you can't manage your own personal finances well, they're concerned you may not be able to manage their finances very well. So here's a fun fact. Did you know that your credit score can even impact how much you pay for car insurance? Yes. Some insurers see a low credit score as a sign that you may be likely to file a claim. So they charge higher premium to folks who have lower credit scores. Now, we're not going to go very deeply into the fairness and the biases that are built into the credit score system, at least not very deeply. But I think it is important to know that there are some biases that are set up inherently in the credit system. And so what it is important for you is just understanding that those biases exist, and those biases exist in our financial system. And so how do you want to best position yourself despite those biases within the reporting and the credit scoring system and the financial system? Okay. But now we're going to move on. So now that we know how important a credit score is, let's break down the main factors that actually influence your credit score. Your credit score isn't just pulled out of thin air. It's based on your financial behavior. And understanding these factors can help you figure out how to improve your score. Let's get into some 5 key factors that make up your credit score. The first and the biggest affecting your credit score is your payment history. This accounts for a whopping 35% of your score. And it's pretty straightforward. Do you pay your bills on time or not? If you've got a history of late or missed payments, your credit score will take a hit. Here's a great tip. Set up automatic payments for your credit cards, utilities, loans to ensure you never miss a payment. Even one late payment can lower your credit score, and it can stay on your credit report for up to 7 years. So not only on your credit report is it reporting, did you pay this month on time, right? It's also calculating how many missed payments you've had over particularly a 2-year period. So you just want to be mindful. And this is where it's going to be good. And we're going to talk about this a little bit later in the show of knowing what's on your credit report and correcting it as soon as it's possible, even when, especially in times when they've reported false or misleading information. So the second one is credit utilization. This makes up 30% of your score. This refers to the amount of credit you're using compared to your total available credit. For example, if you have a credit card that has a limit of $10,000 and you're using $5,000, your credit utilization rate is 50%. Ideally, you want to keep your credit utilization rate to 30%. The lower, the better, which is a signal that says you are managing credit really, really well. Here's another tip. If your credit utilization is too high, let's say 70, 80, 90%, consider paying down your balances or request a credit line increase. But don't spend more just because you have more credit. Okay, that's the important part. But if you understand this, if you ask for a credit line increase, let's say you ask for a $3,000 credit line increase on a credit limit of $10,000, well, now that utilization of 50% with the $5,000 you have outstanding now comes down to maybe like 35, 40%, right? So you've instantly adjusted your credit utilization by asking and hopefully getting approved for a credit line request. Now, credit line requests typically don't ding your credit. They're usually going to go off of your income information and your current payment history information with that credit card company. But it's always worthwhile to ask for. And I would encourage you to ask for it, whether you need it or not, once a year. Because once again, the higher your credit utilization, if you're keeping your balances low or you're paying off your balance every single month, that once again is going to be all 5 stars for you when it comes to what is your credit score. Next is your length of credit. The length of your credit accounts counts for 15% of your score. Lenders like to see that you've been responsibly managing credit for a long time. This means the longer you've had credit cards open, the better. However, if you're just starting out, don't worry. Everyone has to start out somewhere. And here's another tip. Don't close your old accounts, even if you're not using them. Keeping them open can help boost the length of credit factor as long as you're in good standing with all of those accounts. I have accounts that I've had now for 20 years that I've never closed. Now, a couple of them have closed on their own. Either the bank has merged or they have something in their terms and conditions that says if the card isn't used after a certain amount of time, particularly department store credit cards, they will either send you a notice more often than not to say, hey, we've noticed you haven't used your card. If you're not going to be using your card in X amount of time, we're going to close this card. But typically they'll tell you that in advance. And then what you want to do is maybe make a low purchase. Particularly purchasing is so easy now. You can buy something and have it shipped, pay that off as soon as you order it. And then once again, you'll have restarted the clock on that credit card. So another factor that influences your credit score is the actual credit mix, which accounts for about 10% of your score. This refers to the variety of credit accounts you have, like credit cards, car loans, mortgages, personal loans, home equity line of credit. Lenders like to see that you can handle different types of credit responsibly. Here's another tip. While you don't need to go out and get every single type of credit, having a good mix of revolving credit like credit cards and installment credit like an auto loan can work in your favor. And finally, we have a new credit card, which accounts for the last 10% of your score. This refers to how many new credit accounts you've opened recently. Opening too many accounts in a short period of time makes lenders nervous, as if you might suggest that you're desperate for credit and taking on too much debt. Here's another tip. Avoid applying for multiple credit cards or loans at once. Each time you apply, it generates a hard inquiry on your credit report, and too many of these can lower your score. Now, sometimes when you're going to buy a car, you're going to multiple dealerships, and in order to get the financing and find out what the actual deal that they can make for you, you may have to have your credit card report pulled multiple times. So here's something that you can do. Once you've gone to the first dealership and they have pulled your credit score, sometimes they have the ability to actually print out what they received. And then what you can do is take that printout to the next dealership if you're trying to shop around. This way you can say, hey, another one, you're letting the second dealership know, hey, you're shopping around and you're serious because you already had your credit report pulled. So it entices them to get you a better deal. Remember, we had a whole episode on negotiation, right? But it also prevents you from getting another inquiry, even if it's a soft inquiry on your account, on your credit report, because you're providing them with the report that was just provided. Okay. So moving on, some common mistakes. Now that we've covered the key factors that influence your credit score, let's talk about some common mistakes people make that can hurt their credit. Sometimes we can damage our credit without even realizing it. So let's make sure you're avoiding those pitfalls. 1, making late payments. We've already mentioned this, but it's worth repeating. Late payments are one of the worst things you can do for your credit score. Even just one late payment can cause your score to drop significantly, and it's crucial to stay on top of your bills. If you're having trouble keeping track of payment dates, use your phone's calendar to set up reminders on your banking app or on your calendar to alert you when a payment is due. I actually like to put in my phone 5 days before it's due, because I know sometimes I just get busy and things fall through the cracks. But if I know if I've got this 5-day window, I'll be more or less likely to get jammed up and be busy. But also, once again, going back to just automatic payments, it just makes sure that you don't have to worry about that. Number 2, maxing out credit cards. Maxing out your cards is another big no-no when it comes to your credit score. High balances signal to your lenders that you might be over-reliant on credit, which makes you a higher risk. So try paying off your balances in full each month, particularly if you're accruing points. That's what I do. I put everything on my credit card and then pay it off. It becomes more like my debit card, but I'm also getting 2 and 3x points that I then use for travel and other holiday gifts and things like that. If it's not possible, aim to keep your balances as low as possible to maintain a healthy credit utilization score. Next, close old accounts. Many people think that closing old accounts is a good thing, but in reality, it can hurt your credit scores. Remember, the length of your credit history is an important factor, and closing old accounts shortens that history. So unless the account is costing you a lot in fees, consider keeping it open and using it occasionally for small purchases. 4, last but not least, as tempting as it may be to open up a new credit card for rewards or apply to multiple loans, doing this cannot hurt your credit score. Too many hard inquiries can lower your score, and it makes you look like you're desperate for credit. Really only apply to credit when you need it, and space out your applications to avoid negative impacts on your score. So there you have it. We've uncovered the basics of credit scores and the factors that influence them. The key takeaway here is that your credit score isn't some mystery number that you can't control. It's based on clear, actionable factors. The more you understand these factors, the more you can work on improving your score. In the next segment, we're going to dive into some practical tips for boosting your credit score, including things that you can start doing today to see actual results. So I want you to stick around, and that's where, because we're just now starting to get started. Before we move on to the next segment, I challenge you to check your credit score today. You can do it for free on websites like Credit Karma or Annual Credit Report. once you know your score, you can start making a plan to improve it. So once again, coming up next, I'm going to talk to you about how to boost your score really fast. Don't miss it, and be sure to subscribe to Do Different Better Show for more financial tips, and I'll help you crush your money goals. Stay tuned. I'll see you back after the break. Rasmussen, and today we are doing a deep dive into credit scores, how they work, what they mean for your financial future. If you're just joining us, don't worry. In the last segment, we covered the basics of a credit score and what are the factors that influence them. So now let's talk about how your credit score directly impacts your financial opportunities. We're taking real world implications here. Loans, credit cards, and even your ability to rent an apartment. So buckle up. Because understanding this can give you a serious financial edge. So let's get to it. First things first, let's talk about one of the most common ways your credit score affects you, getting approved for loans. Whether you're looking for a mortgage, a car loan, or a personal loan, your credit score plays a huge role in determining whether you're approved and what the terms that are going to be offered to you by the financing company. So let's start with the big one, buying a home. Your credit score is one of the primary factors that lenders look at when deciding whether to approve your mortgage application. A higher credit score can mean the difference between getting approved for that dream home or having to settle for something less. It also determines the interest rate you'll be paying over the life of the loan. So here's an example. Let's say you're applying for a $200,000 mortgage. If you have a credit card of 780 or above, you might qualify for an interest rate of 3%. But if your score is closer to a 620, you could be looking at an interest rate of 4.5 or higher. While that is only a 1.5% difference, that difference in interest rate can cost you tens of thousands of dollars more over the life of the loan. So a good rule of thumb that I was told when I was first looking and getting ready to purchase a home is for every percent on that you're paying extra. So I just gave you an example, 1.5%. Typically turns out to be an extra $100, I think, of payment, right? So think about an extra $100 every month for 12 months is $1,200. $1,200 over the course of 20 years, that's $24,000 that you're going to pay because of your credit score. And that's just a small example, right? So this is what I mean by wanting to make sure that you have a handle on your credit score, because as you start to apply for different opportunities, it can definitely make a difference and end up costing you a lot of money. So the second one is auto loans or car loans. Your credit score works in a very similar way. A higher credit score means better terms, including a lower interest rates. Let's say you're buying a car for $25,000. With a credit score of 720 or higher, you might get an interest rate of 4%. But if your score is, say, 600, you may be looking at an interest rate of 10% or more, right? That's a big difference in your monthly payment costs, right? So remember, if we used our equation and we're talking about a higher credit score getting 4%, a lower credit score getting 10%, that's a 6-point difference. That might mean that you are paying maybe $60 extra a month in your payment, 60, maybe $100 extra in your payment than you would if you had a better credit score. So you may even want to decide to delay getting a car loan or a mortgage until you get your credit score boosted a little higher than what it is if you know that it's not in the best position for you. Here's a pro tip. If you know your credit score is less than stellar, don't be afraid to shop around for better loan terms. Some lenders are more flexible than others, and you may be able to find one that offers decent terms, even if your credit score isn't all that great. Remember, going back to our show on negotiating, this is where that comes in. So even when you're not in the best position, there are things that you can do to at least optimize the situation that you're in. So now let's shift gears and talk about how the credit score affects your access to credit cards. Your credit score is one of the primary factors credit card issuers look at when they're deciding whether to approve you for a credit card and what your credit limit might be. So let's start off with, if you've got a high credit score, think 750 or above, and I would even say 700 and above is actually really, really good. You're in a great position to get approved for premium credit cards and great reward programs. You're also likely to be offered higher credit limits, which gives you more spending flexibility. Sorry about that. On the other hand, if your score is lower, you might only qualify for cards with higher interest rates like 26, 27, 28. Now interest rates are like up to 30%. Thank goodness we recently had a cut in the Feds lowered the interest rate, but it's still pretty high when it comes to credit cards. And in some cases, you might not get approved at all. This can be a real obstacle if you're looking to build credit or make a large purchase. We just recently had to purchase a brand new refrigerator. And thank goodness we had a credit card. We didn't have anything on that credit card. It was a big box home improvement store credit card. And so because we had that credit card and we didn't close the account, instead of paying cash, we were able to buy the refrigerator with the credit card and get 24-month terms, which is almost like using our cash, but we didn't have to give all of our cash right away. We're set up on monthly payments. So I set up my credit card to have auto pay to pay the amount to make sure that that refrigerator was paid off in the 24 months of free financing that the improvement store was offering. So here's another big factor, and that is interest rates. First, let's just talk about what an interest rate is. An interest rate is what they're charging you to lend you the money, right? So they want to make money off of their money, because if they're lending it to you, they can't lend it to somebody else. So what banks and financial institutions do is they charge what are called interest rates. The better your credit score is, the lower the interest rate that you're likely to be offered on that credit card. This is really important because carrying a balance on a high interest credit card can lead to massive debt that can be just excruciatingly painful to get out of. I can tell you, I talked about this on the first episode. I've been in large scale debt a couple of times. I was with a partner who wanted to be a real estate mogul. We had bought multiple properties, but we didn't have the cash to renovate those properties. So all of the expenses went on the credit cards. Things didn't work out with me and this partner. And I was basically stuck with $60,000 of debt in paying off these credit cards, right? So imagine $60,000 of debt with a high interest payment over time. It almost killed me. But I am a phoenix rising. I'm telling you, you can survive. You can get to the other side. I did it. I know you can do it. But here's an example, just to clarify my point. If you have a credit card with an interest rate of 24% and you're making the minimum payments, you could end up paying thousands of dollars more in interest over time. But if you've got a credit score, you could be paying significantly less in interest, freeing up more of your income for saving, investing, or maybe that trip that you've been wanting to take for a while. And let's not forget the rewards programs. I'm a big, huge fan of getting a card with some kind of points, rewards that fit your life. So if it's rewards that gets you gift cards for Target and the grocery store, great. Now you can spend all your money on your groceries based on your points, right? If you're using that level of usability. But many premium credit cards offer cash back, travel points, and other rewards. But these cards are typically reserved for people with higher credit scores. The better your score, the more options you have for finding a card that rewards you for your spending habits. So now that we've covered credit card, now that we've covered loans and credit cards, but did you know your credit score can affect so much more than that? Let's talk about some of the lesser known ways your credit score can influence other areas of your life. Number one, renting an apartment. Looking for a new apartment? Your credit score is a key factor in whether you get approved by the landlord. Landlords often run credit checks to make sure you're financially responsible before agreeing to rent to you. They'll also check your job. They might do references. A low credit score could mean that you're required to pay a larger security deposit, or worse, it could result in your application being denied altogether. Particularly if rental applications, it can be competitive depending on the market that you're in. So if they've got two people who they really like, they both have good jobs, your credit score could be the determining factor between you getting the apartment or somebody else getting the apartment. And what they're looking at is, thinking about if your credit score is low, the landlord might see you as a risk. They might worry that you won't pay your rent on time, or you are in situations where you can't pay your rent on time, which could lead them to deny your rental application no matter how much money you have in the bank. 2, setting up utilities and services. Here's something that surprises a lot of people, particularly young people going and moving out on your own. Your credit score can also affect your ability to set up utilities like electricity, water, and even your cell phone plan. Utility companies often check your credit score when setting up a new account. If your score is low, they might require you to pay a deposit up front, which can range from anywhere from $100 to $500, depending on the type of service. But here's a pro tip. If you're struggling with low credit scores, see if your utility company offers a payment plan or reduced deposit for new accounts. Okay? Now let's talk about insurance. Did you know that your credit score can affect how much you pay for your auto and homeowners insurance? Yes. Insurance companies often look at your credit score when determining what your premiums are going to be. Studies have shown that people with lower credit scores are more likely to file claims. Not sure why that is, but that's what it is, which is why insurers might charge you more if your credit score is on the lower side. Here's an example. If you've got a credit score of 700 or higher, you might pay $800 a year for car insurance. But if your score is closer to 600, the premium could jump up to $1,200 or more. That's a huge difference, and it's all just because of your credit score. All right. We've talked about how your credit score can open up doors or close them. But what happens when your credit score is in bad shape? Let's talk about the consequences of having bad credit. And we've talked about some of these, but I just want to put a finer point on these. Number 1, higher borrowing costs. One of the most immediate consequences of borrowing or of bad credit is the cost of borrowing. You'll likely face higher interest rates on everything from personal loans to credit cards to mortgages. This means you'll pay more interest over time, which can drain your finances and make it harder to get ahead. 2, difficulty qualifying for loans. Bad credit can make it difficult for you to qualify for loans and credit cards at all. Lenders may review or see you as a high-risk borrower and deny your application. This could mean missing out on really important opportunities like buying that home or starting that business that you've been wanting to do. Number 3, limited financial flexibility. Perhaps one of the biggest consequences of bad credit is the loss of financial flexibility. Without access to credit, it's harder to make large purchases, cover emergency expenses, and take advantage of financial opportunities. It can feel like you're stuck on a cycle of limited options, and I don't want you to feel that way. So, as you can see, your credit score affects so much more than just loans and credit cards. It plays a huge role in shaping your financial future, from your ability to rent an apartment to the cost of your car insurance. But don't worry, bad credit is not a life sentence. I've told you, I've gone through my own ups and downs. You can recover. You must be patient, you must be diligent, and you must be disciplined. But you can improve your credit score with the right habits and strategies. And so we are going to be really talking about this in the next segment. I'm going to really talk about how you can improve and maintain a healthy credit score. So if you're feeling overwhelmed and you're wondering, Elaine, I don't even know where to start, how to start boosting my credit. I want you to stick around because I'm going to give you some really great practical tips. So that's it for this segment. Take a moment to reflect on how your credit score might be impacting different aspects of your life in ways you may not even know it. You might want to check with your employer and see, are they regularly checking your credit score? Maybe it's on an annual basis. Maybe it's on a 3-year basis, but see, where are people checking your credit score and how often they are checking your credit score? This can be done by once again, pulling your credit report. You get a free copy of your credit report once a year. If you've been turned down for credit recently and you already had requested your one free report for the year, once you've been denied, you can use that denial letter to get a more updated credit report at no cost. Okay. But once again, I want you to take a moment, reflect on how your credit score might be impacting different aspects of your life. If you're ready to level up with your credit health and improve your financial opportunities, I want you to stick around for the next segment where I will walk you through some actionable steps to boost your score. So don't forget to hit the subscribe button and share this episode with anyone you think needs a little boost to their credit or their credit score needs some TLC. I'll see you back after the break when I show you how to do different better. Hey there, beautiful people. Welcome back to the Do Different Better Show. I am your host, Elaine Rasmussen. And if you stuck around for the last two segments, you already know that we are well knee deep into becoming credit score pros. We've covered the basics of what a credit score is and why it matters. We've also discussed practical ways for you to boost your credit score right away. Now, in this final segment, we're going to talk about some long-term strategies to maintain a healthy credit score and keep building it up over time. So if you want to know how to keep your score up and stay financially empowered, stick around because it's going to be a game changer. So we all know the saying, consistency is key. And when it comes to credit scores, that could not be more true. While quick fixes can boost your score in the short term, maintaining and improving your score over time requires commitment and smart financial habits. The good news, you don't have to be perfect, but you do need to be consistent. Here's why consistency matters. Your credit score is essentially a reflection of your overall financial behavior. Are you making timely payments each month? Are you managing your debt responsibly? Are you avoiding risky credit habits like maxing out credit cards and applying for a lot of new loans at once? When you consistently do the right things, your score naturally improves and becomes easier to maintain. But let's break it down a little bit more and discuss how to stay consistent and which habits really make all the difference. First things first, let's talk about automating your payments. And we talked about this a little bit earlier. One of the easiest ways to stay consistent with your credit score is to make sure you never miss a payment. Remember how we talked about earlier, your payment history being the biggest factor in your credit score. Well, it's true. One late payment can have a ripple effect on your score, and it's something you want to avoid at all costs. The simple solution, set up automatic payments. Most banks and credit card companies allow you to automate payments so that your bill is paid automatically each month. You can choose to pay the minimum balance, a fixed amount, or even the full balance. This way, you don't have to worry about forgetting to make a payment. Did you know that setting up an auto pay can actually improve your credit score because it builds a track record of on-time payments over time? It's like setting yourself up for success without even knowing that you did it. Now, I talked a little bit earlier about paying off the balance, and then I talked a little bit about making payments for the refrigerator. So let me just talk about a little bit of the difference. Now, my credit cards, one, they have a higher interest rate. And once again, I'm leveraging them for points. So it's an advantageous as a credit card for me to be paying that off every single month. As opposed to the refrigerator I bought, when I bought the refrigerator, I got terms with the charge card of the home improvement store of getting free financing for 24 months. So as long as that item is paid off in 24 months, I will pay zero interest. So I want to be clear about, because I don't want you to be confused about, well, Elaine, you told me in 1 minute to pay it off every month, and the next minute you said that you're making payment. So once again, the qualifier in that charge card situation for my refrigerator was I received from the home improvement store's credit company that to pay this refrigerator over the course of time at 0% interest. So as long as I made the payment between now and 24 months to pay enough to pay off that refrigerator, I'm not paying any interest on my credit card at all, which allows me to keep, instead of paying what the amount of the refrigerator was cash, I'm keeping my cash, I'm putting it in a savings account, I'm building up interest where I'm getting paid interest on that money, but I'm only making a payment every month for the next 24 months. So this is kind of, if it sounds like a money Jenga game, it is, okay? But number 2, keeping your credit utilization low. So once again, I'm going to talk about credit utilization, and we touched upon this earlier, but I want to go in a little deeper again. Credit utilization is the second largest factor in your credit score, accounting for 30%. This is how much of your available credit you're using at any given time. To keep your score in good shape, the general rule is to keep your utilization below 30%. But if you really want to boost your score, aim to keep it below 10%. This shows lenders that you're not relying too heavily on credit and that you manage your spending responsibly. Now, once again, I wouldn't say that 10% should be your goal that you put up on your board. Your lifestyle may not accommodate for that. And once again, I use my credit cards for my business, and my personal credit score is connected to my business credit cards account. So even though I'm racking up probably close to my credit limit every month, I'm also paying it off every month because I'm not putting anything on the card that I wouldn't have paid cash for, right? I have special cards that I use for big purchases that are related to the business or big purchases that are related to my home renovation. So I have one credit card. I only use that credit card for my home improvement expenses. That way, if I do need to pay it over time, I'm keeping that balance at a low balance if I need to pay that over time, because that is not at zero interest. It is at a particular interest rate. So one trick to keeping your credit utilization low is to make multiple payments on your card throughout the month. And once again, you can automate this. You can have it on the day before that it's due and maybe halfway in between your billing cycle. You don't have to wait until the due date to pay off your balance. If you pay off part of the balance early, it reduces your utilization rate when your billing cycle ends, which can improve your score. So this is something that you can do, particularly in the short term of making a payment halfway through the billing cycle. So here's an example. Let's say you have a credit card with a limit of $10,000. You've charged $3,000 on it. This gives you a utilization rate of 30%, which is okay, but it could be better. If you pay $1,000 mid-cycle and then another $1,000 before the due date, you've reduced your utilization to 10%, which is a much better credit score. Now, I'm not sure that I would recommend this as a regular practice, but if you know that you've got a big purchase coming up, like a home purchase, like a car purchase that you're going to make, you might want to start doing these things 3 to 6 months in advance of when you know you're going to make that purchase. Now, sometimes, like my son was T-boned, he didn't know that he was going to have to buy a new car. But once again, here's another trick. I have him on my credit card since he was a very young person. So by the time he got to be 25, he already had a really good credit score because he had been on my credit card accounts. So he was able to go out and get the car that he wanted at a very great interest rate. Number 3, going back to what we were talking about, I digress for a second. Another long-term strategy to maintain your credit score is to avoid closing old accounts. A lot of people think that once they've paid off a credit card, they should close the account. But this could actually hurt your score. Remember, one of the factors that influences your credit score is the length of your credit history. The longer you've had credit, the better it is for your score. Closing old accounts shortens your overall credit history, and it also reduces your available credit, which can increase your utilization. Yikes, that could be a double whammy. Instead, keep those old accounts open, even if you don't use them that often. You can make a small purchase every now and then and keep the account active, but don't close it unless there's an annual fee or some other reason that makes keeping it open too costly. When you go for a home loan, or if you're going for some sort of big purchase that requires some sort of debt or loan, sometimes you might show the person who's going to be managing the financing, hey, here's what my credit score looks like before you pull it. Is there anything that you would be concerned about? And they might say, hey, based on our policies and practices, it would be ideal for you to close these two accounts. Then that's something for you also to consider. Once again, it's always a good idea to step into the finance office, whether it's a car finance office, a bank loan for your business, or a mortgage. Show them your credit report in advance, and if you can, and say, hey, I'm going to be looking to buy a home in 3 months. I'm looking to buy a business. I'm looking to get a line of credit for my business. I'm looking to buy a car. Based on your current financing terms and conditions, is there anything on my credit report that would be concerning? Now you're going to get the information you need to improve your score, so that will put you in the best position to retrieve or obtain that loan for whatever the purpose is that you're getting the loan for. Number 4, finally, let's talk about hard inquiries and why it's important to avoid having too many of them. A hard inquiry happens when a lender actually pulled your credit report before giving you a loan or a line of credit. This can happen when you apply for a new credit card or car loan or a mortgage. So while 1 or 2 hard inquiries won't tank your score, having too many within a short period of time can signal to lenders that you're trying to take on too much credit too quickly, which is a red flag. Hard inquiries stay on your report for about 2 years, so you want to be mindful of how often you apply for new credit. If you're shopping around to make a big loan, like a mortgage or a car loan, don't worry about the multiple inquiries from different lenders within a short period of time. Credit scoring models typically group these inquiries together and treat them as one single inquiry, so you're safe as long as you're not applying for multiple types of credit. My word of caution, though, that I will say is that I recently was interested in participating in a program that was going to provide me with some low financing to do some improvements on my home. They did a hard inquiry and my credit score went down by about 50 points. Now, I think they're making changes to the algorithms, because I also did some research and found that yes, while I took a big hit to my credit score, it will take about 6 months to build that back up to where it was. So you just want to be mindful once again of these rules are kind of changing very quickly in the moment as things are happening with AI. These credit reporting companies are getting smarter and more practical about their scoring mechanisms. So these are always changing. Once again, being just very mindful and fiscally mindful around any of your credit opportunities. Finally, we're going to talk about the final long-term strategy for maintaining a strong credit score is to monitor your credit regularly. This is key because it allows you to spot errors and suspicious activities that could be hurting your score without you even knowing it. You can check your credit report for free once a year at annualcreditreport.com. I recommend keeping a close eye on your score through services like Credit Karma, and I think now Intuit bought Credit Karma. So if you've got QuickBooks, you actually have access to Credit Karma through QuickBooks, since they're also owned by Intuit. But your bank also has some credit monitoring tools. Because of many of the breaches that have happened with credit card companies, you may have received something in the mail that says you are entitled to a credit monitoring service for X amount of time for free. So these are all things that you want to take advantage of. Definitely call your credit card company and say, do I have access to these services? Because almost every major credit card company has been breached. And so part of their reconciliation has been that they need to offer free credit monitoring services for a certain amount of time and or free access to your credit report for X amount of time. Many of these services are free and will notify you of any changes to your score or if new inquiries come onto your report. But once again, here's an action step you can take. Set a reminder to check your credit report at least twice a year. This way, you'll catch any mistakes or issues early and can address them before they impact your credit score. So, to wrap things up, maintaining a healthy credit score isn't rocket science, but it does require some long-term planning and consistent habits. From automating your payments to keeping your credit utilization and monitoring your score regularly, these strategies can help you not only improve your score, but keep it strong over time. And the good news is, once you develop these habits, maintaining a great score becomes second nature. And trust me, the benefits of a high credit score, like lower interest rates, better loan terms, and even lower insurance payments, are well worth the effort that you're going to be putting in. So, here are some practical action steps you can take right now. Number 1, if you haven't already, set up automatic payments for all your bills, especially your credit cards. This will ensure that you never miss a payment. Number 2, review your credit utilization and try to keep it below 30%. If your utilization is high, consider making extra payments mid-cycle. And number 3, check your credit report for any errors or inaccuracies. You can do this for free at annualcreditreport.com or use services like Credit Karma to monitor your credit score regularly. Now that you have these strategies in your toolkit, I challenge you to take control of your credit score and keep improving it. Share your credit score success stories on our social media using the hashtag Do.Different.Better. I want to celebrate your wins with you. So that's it for today's episode of Do Different Better. I'm your host, Elaine Rasmussen. I hope you're feeling pumped to get started to pump up your credit score and leverage your score to keep you in great financial position. Join me next week. I'll be demystifying hedge funds. I'll take you on a no-nonsense tour through the high-stakes game of hedge fund investing, from long and short strategies to the famous and infamous 2 and 20 fee structure. I'm going to be breaking down the key strategies, risk, and rewards of this elite investment club. And not only that, we'll also talk about whether hedge funds are right for you. Before you go, make sure you subscribe to this podcast and leave a review if you're loving what you're hearing. And don't forget to share this episode with friends. Let me know what you think of the show. We love comments, so tell us how this show has helped you. If there's a money or finance question you have, or if there's someone you want me to interview, hit me up on LinkedIn or Instagram at Do Better with Elaine. Until next time, stay empowered, stay focused, and I'll see you next time when I show you how to do different better.